For decades, when markets got shaky, investors ran to US Treasury bonds. They were the ultimate safe haven. Now, something fundamental is shifting. We're seeing money flow out of bonds and into assets like Bitcoin. This isn't just a blip or a quick rotation. It's a profound regime change. And by the end of this, you'll understand exactly what's driving it, why it matters, and what to watch next. This isn't about a single event. It's about how the very plumbing of global finance is being rewired, challenging long-held assumptions about where safety and growth truly lie. Two major forces are colliding to create this divergence. First, the US Treasury has been increasing its bond buybacks. This means the government is buying back its own debt from the market. Think of it as injecting liquidity into the system. It's a move that, in theory, helps manage the national debt and keeps markets stable, but it also has a ripple effect. Second, we're seeing a significant reemergence of aggressive global trade tensions. The recent US-Canada tariff dispute is a prime example, but it's part of a broader trend of countries using tariffs and trade barriers more frequently. These aren't isolated incidents, they're systemic shifts. When the Treasury buys back its own bonds, it reduces the supply available to the market. This pushes down the yield, or the return, that those bonds offer. Suddenly, that traditional safe haven isn't offering much of a return anymore. Investors who still need to generate growth and income are forced to look elsewhere. They're pushed further out on the risk curve, actively searching for assets that can deliver real returns. Simultaneously, trade disputes create massive uncertainty for traditional currencies and equity markets. If tariffs are flying, the value of a country's currency, or the profitability of its companies, becomes much harder to predict. This combination chips away at the foundational appeal of traditional assets. Let's break down the chain. US Treasury buybacks inject significant liquidity into the financial system. This abundance of cash, combined with lower bond yields, makes fixed income less attractive. Investors then rotate that capital into assets perceived to have higher growth potential or those that are uncorrelated to traditional markets. Think equities, but increasingly digital assets. At the same time, escalating trade tensions create volatility and uncertainty in traditional currency and equity markets, particularly for countries directly involved. This makes assets like Bitcoin, which are seen as decentralized and inflation-resistant, far more appealing as a hedge against this instability and as a recipient of that newly freed capital. It's a powerful feedback loop favoring new asset classes. Bitcoin isn't just benefiting from capital flight from specific currencies. My read is that it's benefiting from this macro-level shift in risk appetite. It's a fundamental reevaluation of where capital should be allocated. The market is increasingly viewing Bitcoin as an uncorrelated asset, meaning its price movements aren't directly tied to the whims of traditional markets or central bank policies. This perception is strengthened by renewed optimism around cryptocurrency legislation in key jurisdictions, which gives institutional investors more confidence. So you have liquidity pushing investors to take more risk, traditional markets facing new uncertainties, and a growing acceptance of digital assets. It's a perfect storm, creating a powerful tailwind for Bitcoin. From here, there are three critical levers to watch. First, keep an eye on how global trade disputes evolve. If tariffs continue to escalate, or if new major trade wars emerge, we'll see further pressure on traditional currencies and equity markets. This will reinforce the demand for uncorrelated assets. Specifically, watch the stability of the Canadian dollar as those US-Canada tariffs take full effect. Second, monitor any shifts in the US Treasury's bond buyback strategy. If they scale back or change their approach, it could impact overall market liquidity and investor risk appetite. A significant change here would alter the fundamental tailwind for risk assets. Finally, watch for continued progress on US cryptocurrency legislation. Clear regulatory frameworks would be a major catalyst, either reinforcing Bitcoin's appeal and inviting more institutional capital, or introducing new uncertainties if the outcomes are restrictive. This isn't just about bonds versus Bitcoin. It's about a broader reevaluation of how capital is allocated in a rapidly changing world. The old playbooks are being rewritten. Understanding these underlying mechanics is crucial for navigating what's next. For a deeper dive into the data, my full breakdown, and the specific levels I'm watching, you can find it all at korra.finance.